Welcome back. You're tuned into Bazaar Morning Call and hope you're having a good morning. Well, for starters, going by the overnight cues, you had the Troika, which is the US yield, Brent crude prices, as well as the dollar index. All of them had moved unfavorably for our markets, and that could explain partly why we're expected to open up with a bit of a cut. But plenty of stocks to discuss. We have Amnish Aggarwal, Head of Research at Prabhudas Lilladher, who joins us on the show. Hi, Amnish. Thanks so much for joining in. Well, we're going to see a large trade today on TCS. The street sniffed it yesterday, it seems, because in the last 30-40 minutes or so, the stock took a big dive. What's your view on TCS from here on?
See, if you look at all whenever the promoters have come out to sell, whether it was say an ITC, TCS, or many more stocks where promoters have tried to encash, even M&M, I think maybe 10 days back. So we have seen some cut in the stock prices, but it is not a reflection of where the fundamentals of a particular company stand. So I think if the stock is weak due to that particular reason, or if it tanks further, I think these are actually good opportunities to buy fundamentally sound companies.
Okay. What about oil marketing companies, Amnish? The big fear was that, the price cut, the price cut of 2 rupees was just a token one. It shouldn't impact the fundamentals too much. But if crude prices continue to rise, it will start hurting the margins. And we've seen a rise in crude prices, now at a 4-5 month high for Brent crude prices. Your view on oil marketing companies, and amongst them, which one do you prefer? Which one would you avoid right now?
Okay, you see, the main reason for crude price increase is the geopolitical uncertainty which continues to haunt. And I think if the crude price goes up further, and as we are in the election phase, we could see some pressure coming on their marketing margins in the coming quarters. So we are not positive on oil marketing companies structurally. I think we have negative view on most of them. But however, I think the cut in the oil marketing company stocks will also not be very sharp, given the fact that now there is slight bit of, you can say, move away from EV. EVs are not hyped the way they were used to be, you can say, maybe 6 months back or a year back. So to that extent, I think it is an intermediary move which is happening. And if the crude continues to move up, we might see some more softening in the stock price of these companies.
Do you have coverage, Amnish, good morning, on Indigo? You basically have, again, the oil news flow. There is also news from, I think, the DGCA, the regulator, for basically not giving extension as far as the pilot schedules are concerned, essentially asking pilots to get more rest, which essentially means that they'll have to hire more pilots. It's going to be, there are some estimates from Morgan, etc., which kind of put some estimates, cost estimates there. There was also one more data point. Last month, the air traffic growth adjusted for the extra day this February is only 1% year on year. So there seems to be a bit of a slowdown in air traffic as well. I don't know if you have any thoughts here, Amnish.
You see two things. As far as the air traffic is concerned, I think one big reason is the number of planes which have been grounded. If you look at, say, Indigo, I think some 60 to 70 planes are grounded. So similarly, you can say if you are looking at the consolidated data, then I think most of the planes of Go Air, they are inoperational. So predominantly because of the grounded planes, there is no, I would say, fundamental slowdown in the demand as far as the air traffic is concerned. Secondly, you can say the occupancy levels, they continue to be high. I think Indigo was at something like, I think, in the high 80s. So I think these are all, these are not a clear indication of any sort of slowdown as far as your demand is concerned. Now, the second part is that in terms of, say, you're giving rest to pilots or some of these, you can say, for example, if your planes are grounded, you are taking more planes which are to compensate for that. I think some you can say, in between jerks to margins or profitability will continue to come. The only thing is Indigo has run up quite sharply over the, say, past year or so. So if these factors accentuate further, then there could be, you can say, some sideways movement or a little bit of correction. But however, in the longer term, if you see the airline companies, they continue to look good. Near term, some variations in the margins, or you can say margins or cost factors, they can't be ruled out.
Yeah, Amnish, so yesterday we had a bit of a divergent move. You had Lodha, which is Macrotech Developers, which surged sharply, Mumbai-based player. And you had some of these Bangalore players which are still sulking, Prestige and Soba in particular. Both are down about 20-22% in the last 5-7 trading sessions, very quickly. Just your thoughts, what's your preference there in the real estate space if someone wanted to get some exposure?
See, if you look at, say, past year or so, particularly the real estate players which are centered around, say, both NCR as well as Mumbai Metropolitan Region, MMR, they have done really well. And this is to do with, I would say, the very strong pre-sales which are happening in these cities, plus the kind of, you can say, momentum which is there in the prices. So given the kind of move all these stocks have seen in the last 1 year, I think relatively all the, you can say, all the real estate players centered around more, I would say, the South Indian cities where the property price moves have not been that great. So they have underperformed. I think incrementally the returns in many of these stocks will now come at a more moderate pace, because the kind of moves, the kind of pre-sales which we are witnessing over the last year or so, we might see a little bit of slowdown, particularly in the next quarter or so in run-up to elections. And after that, let us see how the things pan out. But definitely, I think kind of run-up we have seen both in pre-sales and the stock prices. It is time to be a little bit cautious, at least in the near to medium term.
Okay, all right. Amnish, final question before we let you go. I was reading a report by Citi on Shree Cement, and what they say is that, it's underperformed Ultratech Cement by more than 30% in the last 1 year or so. And if you get that last 1 year chart of both the stocks, it'll tell you a better picture. But they are saying that from year on, given that volumes and EBITDA per ton could be similar for both these two, they are now shifting focus to Shree Cement. Yesterday as well, the stock was fairly strong and saw a good amount of delivery-based buying. At around this 25,000 rupee mark, will you be interested in Shree Cement?
Okay, I think Shree Cement, yes, as you said, that it has been a relative, I would say, underperformer, but we currently have a preference more for Ultratech in the entire cement pack. But having said that, given the kind of underperformance it has and the way, you can say, some of the raw materials are benign, I think there could be some bounce back in the stock in the coming months. But definitely on the volumes front, I think next say 3 to 6 months could be, you can say, a period to watch out for all the cement companies, because there could be some slowdown in the, you can say, government orders, particularly with elections, and immediately after elections we are going to have monsoons. So I think next few months are going to be crucial for cement companies. The only, you can say, the comfort factor could be a bit on the raw material front, but particularly on Shree Cement, I think it has underperformed significantly, and earlier it was trading at a huge premium also to some of the other names. So given that, there could be some bounce back definitely expected in this stock.
All right. Amnish, we'll leave it there for today. Thank you very much, as always, for that chat. Appreciate your time here on CNBC.